At the end of the day, investors want one thing: higher returns. From the investor's perspective, high yields are always attractive. However, institutions such as the Debt Management Office have a balancing act. They must satisfy investors while also managing the government's borrowing costs. A good example is the most recent Treasury Bill auction, where the offer size increased significantly from 450 billion to approximately 1 trillion. Naturally, increased borrowing requirements put upward pressure on yields.
Good afternoon and welcome to Marina Times. This is another edition of Soft Talk Sunday, and today I'm joined by HerDataStories, respected editor, creator, founder, and publisher.
First of all, thank you for having me. It's an honor to be here.
Personally, I follow HerDataStories and regularly see your publications. You seem to post almost every day.
Yes, every day.
That's incredibly impressive. Congratulations on the consistency. One of the major topics in financial markets today is policy transmission. In your opinion, how effective have the central bank's policy decisions been?
Nigeria is a unique market, so it's important to evaluate policy within that context. I must say that the current CBN leadership has implemented several impressive reforms. At the end of the day, investors want one thing: higher returns. From the investor's perspective, high yields are always attractive. However, institutions such as the Debt Management Office have a balancing act. They must satisfy investors while also managing the government's borrowing costs. A good example is the most recent Treasury Bill auction, where the offer size increased significantly from 450 billion to approximately 1 trillion. Naturally, increased borrowing requirements put upward pressure on yields. While yields did move higher, the increase wasn't excessively aggressive. From my perspective, the DMO handled that auction quite effectively.
Do you anticipate a similar upward movement in bond yields?
Historically, the bond market tends to take direction from developments in the money market. Given the government's increased borrowing requirements, I do expect bond yields to move higher. The increase may not be dramatic, but an upward adjustment appears likely.
Do you expect yields to reach 18% at the next auction?
Ultimately, the DMO has the final say. Investors will certainly push for 18% and possibly higher. However, we've seen in previous auctions that the DMO is willing to reject bids if pricing is inconsistent with its objectives. This remains a classic demand and supply negotiation.
How are treasury desks and institutional investors positioning themselves in the current environment?
Reserve levels have improved recently. Over the past few weeks, we've seen reserves rise significantly. That growth provides an additional buffer against external shocks, particularly in the foreign exchange market. For treasury desks and investment professionals, flexibility remains critical. They're staying informed, monitoring regulations, studying market developments, and adjusting their strategies accordingly. A flexible and informed strategy remains the winning approach.
I'd like to finish with something slightly different. Many economists argue that increasing interest rates helps reduce inflation. Others believe higher rates simply increase borrowing costs without solving Nigeria's underlying structural problems. Personally, I think improving purchasing power may sometimes be more effective than making money more expensive. What's your perspective?
That's a very interesting perspective, and to some extent, I actually agree with you. However, there's only so much that the central bank can do. The CBN's primary responsibility is monetary policy, managing inflation, liquidity, and maintaining financial stability. But inflation, especially in a country like Nigeria, isn't driven by monetary factors alone. There is also a very important role for fiscal authorities. The Ministry of Finance has a role to play. The federal government has a role to play. Structural reforms are equally important if we want to achieve sustainable price stability and stronger purchasing power. While higher interest rates may help contain inflation from a monetary policy perspective, they cannot solve the underlying structural challenges facing the economy on their own. Issues such as productivity, infrastructure, revenue generation, food supply, energy costs, and overall economic reforms all influence inflation and purchasing power. So, although the central bank can use interest rates as a policy tool, lasting economic improvement requires coordination between monetary policy and fiscal policy. It has to be a collaborative effort involving the CBN, the Ministry of Finance, and the federal government, all working toward the same objective.
I couldn't agree more. Thank you so much for sharing your insights today. It's always a pleasure speaking with you. I look forward to having you back for another discussion.
Thank you very much. It has been a pleasure.
For more market analysis, economic commentary, and investment insights, follow Marina Times. See you on the next edition of Marina Times Soft Talk.